An average young person in the US has saved about $10,000 for retirement by their late 20s. While this may not be enough to finance a typical retirement, you will be surprised at how much it can pay in dividends alone. Hello friends, today we will delve deeper into the topic of investing that we discussed in the previous video, specifically how we can create a source of income through dividends. Although $10,000 may not be enough to finance a typical retirement, you will be surprised at how much it can pay in dividends alone. In this channel, we will take a look at different scenarios that provide different income levels. This will give us a preview of how much money we need to become financially independent and how to maximize our investments for more money in the future. It's important to watch this video to the end to prevent mistakes and learn how to maximize your investments for more money in the future. As I always mention in my videos, I would like to briefly explain our main philosophy for new viewers. If you want to be a follower of this channel, you should understand this very well. Firstly, the main philosophy of our channel is not to make people rich, as wealth is only the expectation of people with a low mindset. We create financing for ourselves with 5 main conditions, and then support these finances with investment sources to create additional income sources. We aim to achieve financial freedom by supporting these additional income sources with investments. Our followers know very well that dreaming of wealth for people who are not financially free is pointless. Once we achieve financial freedom, we can comfortably create new income sources with investments and provide all the necessary conditions to achieve our financial utopia. Valued followers of the Financial Utopia channel, we defined our main philosophy in this way. Before we begin the video, I would like to ask you to follow our channel if you are not already a follower and join our family. If you accompany us on this journey, it will make us very happy. If you like the video and leave a comment, it will motivate me and help the algorithm to promote the video. I spend hours on these videos for you, and I am waiting for your support. Thank you in advance, my friends. Now let's move on to our video. For those who are not familiar with dividend yields, we can summarize it as follows. When we buy shares in a company, we become a shareholder in that company. These companies generate profits each year, and they pay a portion of these profits to their shareholders as a dividend. So, friends, the returns that we receive from the companies we are invested in are called dividends. There are many investment options that offer different levels of dividend income. Perhaps the most popular investment is the S&P 500 index. It is popular because it allows you to become a shareholder in 500 large U.S. companies with a solid history of stability and profitability across all sectors and industries. The S&P 500 has a long track record of healthy returns and is strongly recommended by Warren Buffett. If you buy an ETF or index fund that tracks the S&P 500, you will receive a dividend yield of slightly less than 1.5%. With a $10,000 investment in this index, you can expect to earn about $150 per year or $12.50 per month in dividends. While this may seem relatively small, it can provide a significant return when you have a high level of monetary resources. Another common investment is the Dow Jones Industrial Average or Dow. This is another index that investors often refer to as the market after the S&P 500. The Dow consists of the largest 30 companies in the U.S. and is seen as a second indicator of how the U.S. economy is performing. Investors can purchase a fund that tracks the Dow and earn slightly higher dividends of just over 1.5% than the S&P 500. To obtain a higher dividend yield, one option is to purchase a fund that focuses on generating higher income and providing less capital appreciation. These types of funds include stocks of stable companies with a long-term dividend history. For example, the Invesco S&P 500 High Dividend Low Volatility ETF can be used as an example. It offers a dividend yield of approximately 4%, which is significantly higher than the overall rate of the S&P 500. Rather than owning every company in the S&P 500, it only includes the highest dividend-paying companies. Therefore, in the long run, the growth may be lower, but you will have a high level of dividend income even if the stock value doesn't increase significantly. With this fund of $10,000, the annual dividend income will be approximately $400 or $33 per month. There are many other high-dividend funds that are ideal for elderly investors. These types of funds are popular among seniors because they provide more stability. They perform better in bear markets while performing worse in bull markets. Combining this stability with regular income makes them popular among retirees. My followers, you too can invest in this fund little by little to have the financial resources you may need in the future. People can choose a fund that focuses on a specific sector or industry to obtain above-average dividends. Such a fund includes companies in a single sector or industry, such as energy, real estate, healthcare, etc. Due to the nature of their business, some sectors offer higher dividends than others. Let's give some examples of these sectors now. The energy sector is undervalued and offers a high dividend yield due to economic fluctuations, renewable energy alternatives, and regulations. For example, the Vanguard Energy ETF has a dividend yield of over 3%. Real estate investment trusts are considered somewhat risky because they have to pay most of their profits to shareholders as dividends due to their business structure. The dividend yield of Vanguard Real Estate ETF is also over 3%. Investors can achieve high returns by researching and investing in undervalued sectors. Returns occur in the form of dividends and capital appreciation as sectors regain value. A $10,000 investment in Vanguard Real Estate or Energy ETF will generate approximately $300 or $25 per month in income. My friends, we have so far presented examples based on indexes. Of course, another option is to buy individual stocks. Most financial experts recommend that novice investors and small portfolio holders buy index funds or ETFs. This way, you can learn market behaviors, earn stable returns, and grow your portfolio without taking on too much risk. If you are willing to do research and take risks over time, you may decide to choose individual stocks. Looking at the dividend growth history can be a good idea if you decide to buy individual stocks. For example, the dividend history list is a tremendous resource for understanding that a stock has provided 25 consecutive years of dividend growth. A BBV, a dividend aristocrat, currently pays a dividend of 4.5%. A $10,000 investment in this company will provide approximately $450 or $37 per month in dividends. Additionally, you will gain capital appreciation or depreciation depending on the future movement of the stock. Furthermore, it would be wise to evaluate these potential candidates with fundamental analysis to ensure they have reasonable payout ratios, positive earnings, and other various metrics between 50% to 60%. Individual stocks can sometimes present opportunities due to bad news, missed earnings targets, or new management. This can be an opportunity since the stock market tends to overreact. A savvy investor should evaluate the seriousness of such news and make their own decision about the stock price. My recommendation is, if you are not an experienced investor, to stick to tracking funds. Remember, as you deal with these matters, you will gain experience. With these experiences, you can chart a more professional path in the future. Most investors with a portfolio of $10,000 or more and who are far from retirement should seriously consider not focusing on dividends. Why? Because investing in growth stocks has the potential to earn more money in the long run. Dividend-paying investments have historically had lower total returns, so young people should generally aim for growth. Let me show you an example. A 2% difference in your annual return rate can make a big difference in a career. For instance, if a 25-year-old invests $10,000 once and earns an 8% return until they reach 65, they will have $217,000. If they had earned a 10% return, they would have earned $452,000 or more than twice the money at 65. When considering growth stocks, it's important to keep in mind that they can be more volatile. This can be difficult for new investors to navigate during market fluctuations. A great option for younger investors is an ETF like the Vanguard Growth ETF VUG. As the name suggests, VUG invests in large-cap growth stocks like Apple, Amazon, Home Depot, and other large, stable companies. In the long run, the growth index will likely outperform the S&P 500, which is ideal for someone who doesn't need income. So, if you're young and willing to take on a bit more risk, this index can provide you with much more income than dividend yields. Your investments at regular intervals have the potential to earn you incredible amounts of money in the future. The dividend yield from VUG is less than 0.5% because most publicly traded companies pay little or no dividends. Instead, they reinvest their profits to accelerate growth within the business. Due to this low yield, a $10,000 investment will provide you with less than $50 in dividends annually, or about $4 per month. While the dividend income may be low, companies aim to invest in themselves for growth. This results in an increase in your stock value. There are other similar options that historically outperform market returns. People often become fixated on dividend yields and choose the wrong investments based on the timeline. Generally, an investor with a portfolio size of around $10,000 is better off ignoring dividends entirely and focusing on growth. How much of a difference will income make in your life? Whether it's $50 or $400 a year, it won't contribute much to paying bills or daily living expenses. Growth stocks will provide more money as you prepare for retirement. At that point, it makes sense to transition your growth investments to income investments. Don't make the mistake of focusing on dividend yields in the early stages of your investment journey. In summary, my friends, if you are young, you should choose growth stocks and maximize your financial resources. As you get older, invest a certain portion of your growing financial resources in dividend stocks to secure your future. That's all for today. Thank you for listening to me until now. You are on the right track. As I mentioned at the beginning of the video, I put in a lot of effort into making these videos. Please don't forget to like my video and leave a comment, even if it's just a small one. If you haven't subscribed yet, please subscribe and join our community. I love you all. See you soon.